October just delivered the worst job cuts in 22 years, over 1.1 million gone. Consumer sentiment is now lower than at the bottom of 2008. AI giants are hiding 30 billion in debt like Enron 2.0. 7 rare crash signals just fired, while the market is at all-time highs, and a 700 billion QE bomb is about to drop. This is everything breaking right now and what it means for your money. Let's dive in. So let's start with the ADP, which was providing jobs data in the meantime, since the government shutdown prevented the Bureau of Labor Statistics from releasing US job data. And as you can see, the number was positive overall if you add all these up, but it's mostly because of large companies. If you take them out, the small and medium size are actually bleeding jobs. So the number would have been negative. That's something to consider. When you look at the big picture, you look at the headlines, it might look good to have plus 40,000 jobs. But when you look at, it's maybe just the big companies with AI that are hiring, but it might be about to change. So just something to get started. Now let's move on to the job cuts, because basically the economy for the past few months has been described as a no firing, no hiring situation, which was like a slow bleed, because people were fired, couldn't find a job, but not many people were fired. But now it's actually turning. And so as we could see with the job cut from the Challenger report, which I'll show in a second, basically it's the highest level for the month in 22 years. That's huge. And it's the worst layoff since 2009. So, when central banks and government tell you that it's a booming economy, clearly it's not. So this is the Challenger report that reports on cuts. As you can see, it surpassed already 1 million for the year, and the year is not even done. You can see the intense takeoff here on the job cuts. So that's massive. I think that's interesting is that in the past, so at the bottom here, you have the Challenger cuts. When it was at this level, it was actually when the stock market was almost already down 50%. It was during 2009. So, a year after the official beginning of the big crash of 2008. Yet here you look at it and it's like all-time highs and plus 35% in the last 6 months. That makes no sense. And actually, we'll come back to the stock market later on. But I just want to show you the parallel here where the real economy is crashing, yet the stock market is near all-time high. So the disconnect is not only huge, but it's getting bigger by the day. Something else that I wanted to show you is that basically the stats are showing that it's not going to be good in theory. People are expecting that when the government finally does end the shutdown in the US and they release the job data, it's likely going to be negative. So they expect a decline of 60,000 jobs. I think it could be worse, but we'll see. But if it's worse than what they already expect, is going to be a negative number. The stock market could plunge just based on this data. So they have been late for both September and October now for the jobs data. So we'll see if maybe we get something this week or next week. But it looks like the next 2-3 weeks are going to be packed with data that could push the market in one direction or the other, or both. Because if the data is really both good and bad, people will know exactly what to do. This is the University of Michigan, which is very well-known consumer survey, and shows that the sentiment is almost the lowest it's ever been. So you can see here in 2022, people were actually a little bit more worried than they are right now. But if you look at the history, and this chart is going back to 1953, basically people have almost never been as worried as they are right now about the economy. And this is reflected in everything they do, in things they purchase, in how they save, how they invest, and so on. And this chart is showing you that for the first time in US history, the price of a new home has dropped below the median price of an existing home in the US. So this is signaling a major shift in the housing market. This is signaling a major structural shift in the housing market, which is a huge portion of the economy and how people pursue their wealth as well. So this is going to be interesting to follow in the next few weeks and months. So let's start with the Enron moment of the AI bubble. I'll start with this chart, which was with the tweet here. And it was basically identifying that Meta might be doing some kind of Enron style financial engineering, could be fraud or could be just something a bit fishy. But basically, they are pushing a portion of their AI capex off the balance sheet to make it look like it's better than it is. And the other issue is that is something that was kind of underground a few months ago, but seems to be resurfacing. They're basically amortizing GPUs and other assets over a longer period of time than they actually being able to use them, because these AI GPUs, they become obsolete very quickly, like 2-3 years. Yet they push the amortization over 5 or 6 years. And so that's kind of misleading the market in terms of, the real profit that they are making. And there was actually an interesting tweet about from Michael Burry today, which is also outlining that back in 2020, 2021, they were amortizing those GPUs on a much shorter time life, and now it's really pushed. And so this is something that might blow up in their face because they are likely overvalued. And here he's talking about Meta and Oracle, but there are way more companies, and he's saying that there will be more details as well. So this is definitely something to look out for. Something else that's also interesting is look how until this year, so 2025, most of the AI capex was done by using cash, but now it's more and more using debt. And so it seems like everybody is going after AI with debt, yet they haven't been able to turn a profit with AI. So this is either a really good idea or a really bad idea. Another thing that was interesting, I'm sure you heard about it, was last week, Sam Altman from OpenAI kind of meltdown in a podcast, basically, but because someone was asking him if you're only projecting to have 13 billion in revenue for the year, and that was actually the projection at the beginning of the year, didn't change yet. So, 9 months later, they haven't changed the projection for the year, yet he got mad when people ask him, how can you pledge to invest 1.4 trillion when you only bring in about 13 billion in revenue? Like, that makes no sense. And he got really mad about this. And this was the same week that OpenAI actually asked for the government bailout to expand rapidly, whatever excuse they can get. So really seems like the AI bubble is closer and closer to completely bursting. Like there are cracks everywhere, and it seems to be accelerating. So that's really bad news for him, not for AI in general, because just like in the internet in the early 2000s, we actually, the good companies survive and they built from the ashes. And here we have too many things doing stupid things in the AI space. So at some point, there might be a better way to do AI than what they are doing right now. But it's just to show you that even with their rosy projections, they're not looking at making a profit until 2030. And so imagine for no 5 year 4 or 5 years from now, best case scenario, they think they might turn a profit. So this is kind of scary. So another thing that was kind of scary last week is, so that was during the interview with Microsoft CEO and Sam Altman. Microsoft CEO said basically that they have GPUs on shelf that they cannot plug because they lack energy. So, when you have the narrative of GPUs are flying out the shelf, there's an unlimited amount of demand for AI compute and all that stuff. And energy is not something you can just build overnight. Like it takes 10 years or more to build a nuclear power plant that they need to power the GPU hungry AI centers and all data centers and all that. So just another thing that I think you should know if you didn't hear about it in the news. And the last thing about the AI bubble that was kind of in the coffin, at least to me, is Nvidia basically begging the US to buy its GPUs. Like, come on, like for the past 2 years, they've been telling that there's an unlimited demand, that they can't get enough GPUs produced fast enough for all their clients. And now they're saying, oh, China is so close to us, please buy our GPUs. Like, come on. So this to me seems like a desperate attempt by the CEO to kind of prop the eye bubble, because he's seeing, just like we are, that it's about to crack. But yeah, just something for you to consider if you didn't see the news as well. All right, so let's talk briefly about the stock market. So as you remember here, I talked about this is potentially the top. We won't know for weeks. After that, the stock market went down. It was actually saved on Friday at the blue line because initially it went below the blue line because there was a lot of selling during the morning. Looks like big institutional players were selling to retail, and then they kind of stopped. And the price was able to close below the blue line, which was pretty cool because you have automated algorithm and orders that are actually about to massively sell if there is a confirmed close below the blue line, which is the 50-day moving average. It's a very common and very popular moving average to use for long-term support. As you can see, during the topping phase in 2024, at the end of the year, it was kind of chopping around the blue line versus the kind of uptrend we saw before with temporary dips, but then back up, back up. And here it was actually the longest time above the 50-day moving average. So we haven't closed below yet, but it might be coming soon, especially because the rebound today is pretty weak. If you look at the volume in the bottom, Look at that volume candle today. It's nowhere near where it was the few days before, yet the price surged higher. So to me, it looks like the institutional player might have taken a break from selling to give retail the opportunity to buy a dip, and I'll have a graph to show later about that. But yeah, right now I'm not very confident in this. It might still go for a double top, but right now I think the most likely option for the next few weeks is going to be a messy topping process like this. So we'll see how it goes, but I just wanted to give you a quick update on how the market is going. Usually I give more a long-term view or, at least medium-term view, but right now, because it's kind of the opposite of what we saw for the last 6 months, which was a clear direction, I just wanted to give you a quick update to help you better understand what's going and don't fall for the trap of, oh, it rebounded and now it's only going up and it's not going down anymore. Like, it could crash anytime. The timing is the hard part to get, but right now it's way more likely in terms of probability for the stock market for SPY to drop down. And I think before the end of the year, early January at the latest, I think it's gonna retouch the top of the 2024. At the minimum, just for a healthy reset, because this was just a small pullback in terms of like a 3% drop, I think. Yeah, like 4% drop from the peak to the trough. So that's not something big. After such a huge plus 35%, you expect at least a 10 to 15% drop. And so that's why my minimum target for a healthy pullback would be here. If there is a confluence of elements that really push it and there's like a perfect storm, it could, go back to the lows of the April lows. So that would be much lower. So if it goes there, it would be a 30% drop, which, sounds a bit scary, but that's kind of similar to what we had in April, actually. So we'll see. But right now, the market feels messy, feels without direction, running on fumes. And there are so many indicators. I just don't want to overwhelm you with all the ones I'm using. But let me know if this is something that you want me to go into more details about. And here, just a quick two-die fund that also shows you how it can really be messy when you have a top. So this is the kind of thing that really, scares the investors, because one day they could be thinking it's back to going up. The other day it's like, this is the end. And usually by the time people realize that it's a bear market, it's kind of too late, because, for example, here, after the first drop, they might say, oh, that was scary, but we're going back up. So they didn't sell. And, oh, that was scary, but we're going back up. So they didn't sell. And they might end up selling at the bottom here and then not invest for years or decades because, they lost so much money. So it's important to recognize the early sign of a topping process just to be able to manage risk better. Here's another chart I wanted to show you, which is the margin debt. So basically people taking on debt because they think that if they pay 5 or 6% to borrow money, but they make 15, 20% the stock market's worth it. And usually when you have a big move, you can see that this is almost always near a top. So you can see here, in just before the 2020 dot-com crash, in July 2007 was the top as well of the margin use. 2018 here, it was a big crash like the others, but still a minus 20%. Then, of course, at the end of 2021, when everybody was euphoric with the free money. And then, of course, it's right now, which is, out of the chart. So from here, it can go up a bit, of course, but right now the risk reward is, to me, not worth it. So you can decide what it means for you and your portfolio, but it's just something that you should be aware of. So this is another chart that kind of shows you the euphoria and the all-in mentality. So this shows you the call option volumes, which is higher than the put volume. So basically, people are betting everything on the stock price going up rather than going down, or at least protecting a portion of their portfolio. And so as you can see, usually when it goes up vertically like this, and it's a new all-time high, it's usually not a good sign. Another thing I was talking about before is basically last week, as you can see, so it was a negative week in terms of money being pulled out of the market versus put in the market. And who took out the money? Institutionals. Who put money in? Retail investors and a bit hedge funds. So as you can see, this is the rotation you see near the top. Is big money is selling to retail investors like you and me. And this is usually not a good sign because most people buy at the top. I mentioned the Hindenburg woman last week. It was firing a few times, which is unusual, and now it's been firing for 7 days in a row. And so as you can see, that we had a cluster like this at the end of 2022 before the bear market, We had one close to the top near the end of 2024 as well, before the big almost flash crash of early 2025, and now we had it as well. So this is just another sign that things are not as strong as they appear to be if you just look at the price. And also, there's another signal. I don't have a chart for it, but it's called the Titanic warning signal as well, and it also fired a few times last week. And when you have both the Hindenburg omen and the Titanic signal firing at the same time, it's almost guaranteed that the stock market will be down a month from now and potentially a year from now as well. So, it doesn't guarantee anything, but just probability wise, right now everything is stacked against the stock market going up. Doesn't mean there will be a fake out, it just goes up like to 700 on SPY or 7,000 on SPX, just to, get everybody changing their mind, and people closing their shorts and people opening very speculative positions just to be wiped out when it actually crashes. So this is something I actually have seen a lot in the stock market. Before a big move, you usually have a fake out in the opposite direction. So if it's going up, there's going to be a flash crash just to get all the people who have stop loss to be executed out of the market, and also in the other direction, just before the stock market is about to crash, which is something we saw with Bitcoin recently. The last all-time high, the push was kind of vertical, and then I had a feeling it was going to go down like this, which is exactly what happened. So this is just something to keep in mind when you're looking at the short term. Ideally, it's better to look at the long term, but sometimes it's interesting to see what's going on in the short term to better understand the dynamic when we get to a topping phase. One more thing about these clusters I mentioned, the Titanic signal and the Hindenburg omen. When they both trigger near all-time high, this is something that only happened 3 times in history. In 1998, so 2 years before the big crash of the dot-com bubble, in August 2015, and right now. So just something else for you to have more data, but this moment right now is really unusual when you look at history of the stock market. And so that's why it's really hard to predict what's going to happen next. The only thing we know that is that in terms of probability, it's more likely to go down than to go up. So it doesn't mean sell everything. It just means maybe reallocate the portfolio if you think it would make more sense in your situation. Lastly, there are 2 wild cards when it comes to the stock market, especially over the next few weeks and months. The first one is the government shutdown in the US, because when they finish the shutdown and they start releasing the data, maybe all at once, that might actually be either really good or really bad, depending on the data. Could actually be both at the same time, which could be really confusing. And this is really especially true for jobs data and CPI. And in terms of CPI, it's kind of actually scary. Look at this chart. Since 2019 until 2025, it was about 10% of the CPI that was made up when they didn't have the real price or something. But since the beginning of 2025, it's been growing from about 30% to now 40% of the data making CPI is made up. And this is kind of scary because the Fed has been relying heavily on the CPI to justify its decision to cut or not cut, to do QE or QT, money printing or sucking money from the system. And this has huge implication for the stock market and the US economy and the global economy as well. And so right now, how can you have confidence in the CPI, which was not already a good, number to go with because it doesn't reflect the real economy? But when you know that even with that, you have to deal with the fact that they just make up almost half of the data that goes in it, that's kind of scary. So just a side note for the CPI. But back to the shutdown. So right now, people are expecting more bad news than good news coming from the data once the government shutdown is done. However, it could surprise to the upside. You never know, so it will be something to follow. There's also a good news portion that could come with the end of the shutdown, which is that the government right now has about 700 billion in its checking account. It's been growing since the beginning of the shutdown, and so once it's done and they're starting paying people again, so employees and contractors, that 700 billion is going back into checking accounts, into the economy. So that could be a huge spike of liquidity hitting the market, including the stock market. Something else also that might inject a lot of liquidity is the stealth money printing or QE that the central bank might start resuming soon. And so this is something that if they do it at the same time, which is potentially going to happen by the end of November or in December, that could really create a melt-up scenario where the stock market goes almost vertical for a few days or a few weeks before a massive crash, because everything that goes up straight, they usually come fast. They come down as fast as they went up or more. Another thing that could also happen at the same time, even though it's not confirmed yet, is Trump issued a statement saying he wants to take money from the tariffs to send a check, or to everybody except the richer people. And so, based on a few people analyzing the situation, it looks like it might be about 85% of the U.S. population. And so that would be another injection of 400 billion into the economy. And if it's injected directly by sending checks to people like in 2020 or 2021, that could actually be huge, because this means that almost all of it would be spent and invested into the stock market and crypto and all kind of assets that could just go up based on the fact that people have money to put into it. So imagine if everything happens at once, that could be a perfect storm for a melt up before a reversal to the long-term trend. So something to keep in mind and to watch, because right now it seems like they might be aligned. However, for that last portion, the check, today I saw that the Descent actually said that it's not a done thing, and it might actually come in the form of a tax credit for people filing their taxes. So that would be completely different than sending a check to almost all households. So we'll have to follow, but right now it seems like there's a lot of pent-up liquidity that might be all injected at once in the US economy while the stock market is near all-time highs. And so you can imagine how insane it can go from here, and it could kind of become no longer in like right now it's not tethered to reality, but it could become even more crazy in the weeks to come before what could be a once in a generation crash. So we'll have to watch closely what the market and the economy and all these news mean in next few weeks. I think it will become clearer, but right now it's kind of hard to imagine where the stock market will be 2 months from now, even though it's more likely to make a big move by then. And lastly, let's talk about the $1 trillion time bomb in the private credit market. So there was in the news that UBS did shut down two hedge funds, one because it went bankrupt, the other one because there were too many people trying to get their money back. And so they actually just closed the hedge fund, which was something that was kind of similar to what happened in 2007 with Bear Stearns. It was the canary in the coal mine. After that, all the central banks came and say everything's under control. How it ended just a few months later when everything fell apart. So this is kind of scary. Actually, there was another one today where BlackRock lost 100% on another private loan that they made, which just a few days or a few weeks ago, I don't remember, but basically they said, it's all fine, like it usually is, and then it just falls apart, but to zero. And I've seen this many times also with companies or countries being given a perfect credit rating just to be completely bankrupt a day or a week later. Same thing with if you remember SVB during the banking crisis in 2023, like a week before the bank went bankrupt, it was audited by the authorities responsible for checking the banks, and they basically gave it an A plus, saying everything's fine. A week later, it was bankrupt. So you see how those ratings can be very misleading, and in private credit, it's even more murky because you don't really know what's going on until it's too late. So just something that keeps coming up. And so when just like he says here in the tweet, how many of those isolated events do we need before it's no longer an isolated event? It's actually a full-blown crisis. I think people are interested in this sector to really keep it under wrap as much as possible, but eventually it's just going to blow up like in 2008. So you can imagine if it blows up at the same time as the stock market and other things, like this could be the end of the everything bubble, basically. Something else that I'm checking, you may have heard of it. Basically, when you look at the SOFR minus the IRRB, this is the signal that's showing the stress in the banking sector. And so this is not healthy when you have a massive spike like this and it becomes a positive, it's supposed to be negative. And so that's a sign of liquidity crisis in the banking sector. Last week, it went back down a bit because when the stock market goes down, it's actually good for, it's better for the banks' liquidity because people have to sell. And so there's more cash on hand. So banks don't have to try to borrow cash to close their books at the end of the day. But it's definitely something I'll keep monitoring because right now it's getting more and more crazy in terms of spikes and the frequency of those spikes. So that's the full picture. Labor market breakdown, AI accounting tricks exposed, 7 crash omen flashing, $1 trillion credit bomb ticking, all that while the Self-QA is propping up the market, at least for now. If this breakdown helped you, there are 2 quick things you can do to help a small channel like mine. You can hit the like button to show Google that this is a video that they should be sharing, and you can drop a comment to let me know what surprised you or worried you the most. Was it the AI bubble? Was it the UBS and banking sector crisis? Was it the stock market? Was it something else? I read all the comments, so feel free to let me know, and I'll do my best to answer them and to make future videos based on the content that you are the most interested in. If you don't want to miss the follow-up video once the government shutdown ends and the data hits, feel free to subscribe. Thanks for watching, stay alert, and I'll see you in the next video.